hearty welcome to you all for a fruitful learning experience in financial management. In this session, we will be dealing with Module 4. Module 4 is all about leverage analysis and dividend decisions. Before that, let me introduce myself. I am Dr. Binoy Matthew. I am an associate professor and program coordinator of Department of Management Studies, Visvesvaraya Technological University Center for Postgraduate Studies, Muddanahalli. Let us begin with the module and let us have an overview about the module. First of all, this module contains two important aspects in financial management. One is leverages, and the second portion of the syllabus is about dividend decisions. So, these are the contents of this fourth module. I hope you have the copy of the syllabus, but still, just for clarity, let us look into the content of module 4, leverage analysis and dividend decisions. Under that first part, we will be discussing about what is leverage analysis, developing the concept of leverage in finance. That means, we will be discussing about how the concept of leverage is used in finance, or application of the concept of leverage in finance. Then I will take you to the computation and inferences of degree of operating leverage, financial leverage and combined leverage. In leverages, we have operating leverage, financial leverage and combined leverage. So, few problems and solutions on how to know the calculations of operating leverage, financial leverage and combined leverage you will study. Then after that, the second part of the syllabus will be discussing about dividend decisions and policies. Under this dividend decisions and policies, mainly we will discuss about what are the factors affecting the dividend policy, what are the different types of dividend policy, and we will touch upon some of the theories of dividend theories also we will cover in this module. So, I hope you got an overview about this module. So, this contains mainly about leverages. In that, under the first part of the syllabus, leverages, few calculations are there, few calculations are there. That is very simple. For operating leverage, financial leverage and combined leverage, for all these there are formulas, very simple formulas, easy to understand. If you know the formulas, you will be able to solve the problems. Okay. Then the second part is fully theory part, dividend decisions. So, let us have a basic understanding about what is leverages, leverage analysis. You might know the word meaning of leverages. Leverage is nothing but it's an increased means for accomplishing some purpose. That is what leverage is all about. So, it's an increased means for accomplishing some purpose. Means the meaning is, suppose if you want to move a heavy object, if you have an iron rod, you must have seen this wood logs and all, how people move that big wood logs, how the people moves. If you have a long iron rod, keeping that iron rod down the wooden piece or heavy object and using one piece of down below the iron rod and pushing the iron rod down, you will be able to move the object easily. So, that is what the word meaning of leverages, but the same concept is used in finance, that is leverages. So, it's in finance also, it's an increased means for accomplishing some purpose. So, here formal definition is given. You can see that the meaning of leverages. Leverage analysis in finance refers to evaluating the use of borrowed funds, that is debt fund, to finance the acquisition of assets with the goal of increasing the return on equity. So what it says is, it means evaluating the use of borrowed funds. Borrowed funds means, see, as far as a business is concerned, they can use two important sources of finance. For investing in business, money is required. For that, the business can for businesses, they can use two different sources of funds. One is equity source, that means issuing equity shares to the public and raising money, that is one source of fund. You know that equity shareholders are the true owners of the company. So equity source, and another source is debt source. Debt source means issuing debentures, raising deposits from the public, bank loans, etc., etc. All these are debt sources of funds. The debt sources of funds, you know that it carries interest, fixed percentage of interest. Interest needs to be paid if debt source of fund is used, whereas if equity source of fund is used, there is no fixed charge for that. That means equity shareholders, the return which needs to be paid to equity shareholders is called as dividend. So equity shareholders is to be paid dividend, and payment of dividend to equity shareholders is not mandatory, even if there is profit also. It is not compulsory for any company. So both has cost, equity source or debt source, both has cost, but equity source, the cost is payment of dividend, and that payment of dividend is not compulsory, it is not mandatory for a company. Whereas if debt source of fund is used, it is mandatory that the company should pay dividend to the company should pay interest for the borrowings. So here the concept of leverage is used for using the borrowed funds or debt funds to finance the business, for investing in business. Usage of borrowed funds or debt source of funds is called as the concept of leverages. And why the firm needs to use borrowed funds instead of equity funds? The reason is it is for enhancing the profit, or it is for enhancing the profitability, or it is for enhancing the return on equity. Return on equity means, it is, in simple words we can say that the dividend as well as capital appreciation for equity shareholders. So return on equity, what the equity shareholders will get as return, they get return in the form of dividend. So the concept of leverage says that if borrowed funds are used, there are chances of increase in return on equity. That is the concept of leverages. How it happens, we will study in the following sessions. So having understood the basic concept of leverage, let us look into its further details about leverages. Leverages amplifies both potential return and potential risk. So if leverages are used, that means if more debt sources of funds are used, it enhances, it accelerates the potential return as well as the risk. So how it happens means, suppose an existing company that company is in need of say 100 crores rupees for expansion of business. So, this 100 crores, as I mentioned in the beginning, can be raised by way of issuing equity shares or by issuing debentures or using debt sources of funds. If the company raises this additional fund of 100 crores by way of issuing additional equity shares, what will be the result? The result will be the number of equity shareholders will increase. If the number of equity shareholders increases, quite naturally earnings per share, there are chances of reduction in earnings per share. Why? Because earnings per share is calculated as sorry. Earnings per share is calculated as profit available to equity shareholders divided by number of equity shareholders or number of equity shares. So, if number of equity shares increases, there are chances of reduction in earnings per share. Instead of issuing equity shares, if debentures are issued or bank loan is taken or borrowed funds is used, there are chances of higher returns to the equity shareholders, because there is no increase in number of equity shares. At the same time, the interest payable on borrowed funds are tax deductible items. That means, for the payment of interest, after paying interest on borrowed funds, for the balance amount only company needs to pay tax. So, for the payment of interest, company get tax benefit also. So, thereby there are chances of increase in profit after taxes. So, finally, the result will be the earnings per share or the return to equity shareholders will be high. But at the same time, risk also will be high if more borrowed funds are used. Why? Because if there is no profit or if there is reduction in profit, return decreases, reduction in profit, then the company will not have sufficient fund to pay the interest. If such a situation arises, it is risky. So, in order to get more clarity, let us understand this. Same example, company needs 100 crores rupees and this investment is for expansion, maybe establishing a new unit for producing a new product. In that case, one thing is huge investment is required, and this investment is for a longer period of time, and the return from this investment expected after few years. That means, for example, for establishing this new unit, it may take say 3 years time. And we need to acquire land, construct a building, etc., etc. Okay. So, it takes at least 3 years time to establish the company, establish the unit and start producing. It takes 3 years, for example. So, now itself we need to start investing. Suppose if we borrow money, entirely borrowed funds if you use for this investment, for 3 years we will not be having any return from this investment, because we start producing and selling after 3 years. So, after 3 years only, maybe in the 4th year onwards only we get some return from this investment. If that is the case, if entirely borrowed funds are invested, we will not have fund for payment of interest. So, it is risky for the company. But instead of that, if this 100 crores of rupees, if it is raised by way of equity shares, issuing equity shares, this initial 3 years wherein there is no return, it is not mandatory, it is not compulsory for the company to pay any return to the equity shareholders. It is not mandatory. The company can delay or postpone the payment of dividend to 4th year by saying that it's only investment is done, and after 3rd year, there will be huge return from this investment. If that is the case, equity shareholders will be willing to wait for the 4th year to come for getting any return, with the expectation that from 4th year onwards there will be very good return, and thereby they can expect some fair dividend, and also with the expectation of that future profit, there are chances of increase in market value of shares of the company. So, with that expectation, initial 3 years or so, the equity shareholders will wait for future benefit, and it is safe for the company. But instead of that, borrowed funds are used, there is no return from the investment, but at the same time this has to be paid, what interest has to be paid. So, that is what the concept of leverage. If leverage is used, there is potentiality for higher returns, at the same time there is potential for high risk also. So, understanding leverage is crucial for assessing a company's financial structure and the implications of its debt levels. So, leverage in its simplest form is the ratio of a company's debt to equity. So, leverage is, in simple words, it expresses the relationship between the debt and equity of a company. So, we can say that if more debts are used, company is using high leverage. What that is the meaning? If in the total capital structure, if the debt content is lesser than the equity, then we say that the company is using lower leverage. Okay. So, this ratio between this debt and equity tells us how much debt of a company is using to finance its operations and investment relative to how much equity it holds. So, that is what I said. If the leverage is high, meaning is debt portion, borrowed funds is more in the capital structure of the company. So, leverage magnifies both potential returns and risk, as it affects both the upside and downside of an investment or business venture. So, the core idea of leverage is the primary objective of leverage is to enhance the return on equity. So, the fundamental idea of using leverage is enhancing return on equity, because for any company for that matter, the ultimate objective is, in the financial management first module, you must have studied about profit maximization and wealth maximization concept. Profit maximization in its simplest terms, we can say that increasing the return, increasing the profit of the company. So, as in the perspective of shareholders, owners of the company, profit maximization means as and when the equity shareholders get maximum dividend, maximum share in the profit in the form of dividend, there is profit maximization. Whereas, wealth maximization concept says that if the market value of the shares of the company increases, goes up, then the wealth of the shareholders is maximized. That is the meaning. So, here whether it is in the form of dividend or capital appreciation in the form of increase in the market value of shares, ultimate objective of a business is to enhance the return to the equity shareholders. Equity shareholders should get maximum return from the investment. So, that is the primary objective or primary goal of the concept of leveraging. So, if a company can earn more on its assets than the interest it pays, then the company is using high leverage, and there will be the profit will be maximum and the return will be maximum. So, if suppose for example, if a company borrowed, has taken a loan at the rate of 10%, and if the earnings, profit earned by the company for the investment is suppose 12%, then the company is making real profit. Why? Because the cost of borrowed fund is 10%, but the earnings is higher than the cost of borrowings, then the company is profitable. That is the concept of leverage. So, however, if the return on asset is lower than the cost of borrowing, the company may face losses. So, leverage analysis is used to study the return, whether the company will be profitable or not, or what should be the capital structure of a company. That means, in the total capital structure, how much should be the debt in relation with the equity. That decision is taken based on leverages. With this, we will conclude this session, and in the next session we will discuss more about types of leverages and further things in the as per the syllabus. Thank you.